Hello grade 11s and welcome to another Learn Xtra accounting show on partnerships. So you may have watched some of our previous shows in which we did the partnership ledger account. The focus on today's show is on the income statement and on the balance sheet. This is an extremely important section of work that you've got to master because at the end of the year exam you will usually get a question of between 80 to 100 marks on this. These are the adjustments that you've learned in grade 10, and what we're doing is we're extending them to grade 11 where we're going to look at the effect on a partnership instead of on a sole proprietor. So the key focus of this lesson is, first of all, knowing how to prepare an income statement for a partnership. So you will have done an income statement in grade 10 before, and now we're going to adjust the income statement very, very slightly, dealing with a partnership instead of a sole proprietor. And then, what's even more important is preparing a balance sheet for a partnership. And the reason I say it's more important is because this is the section of work where you've got your two new notes. It's notes that you didn't have in grade 10, but they are notes that you will have in grade 12, and you learn them in grade 11 when we start looking at a partnership. So those two notes are the fixed asset note, which you may remember if you've watched our shows on asset disposal or if you've done asset disposal in class, and also the very important current account note, which is normally numbered note 8. So these are the two notes that are new, and these are the ones that I would strongly suggest that you revise and make sure you learn their format. So the format of the financial statements is extremely important. When you go into an exam, you need to know exactly what goes in each note, and then you won't have any trouble doing these adjustments, because the adjustments, the tricky thing about the adjustments is not knowing where the figures that you calculate need to go. So learn the format very, very well, start early, and you won't have any trouble. And what we also have here, when we're doing an income statement and a balance sheet for a partnership, the tricky thing is to do the end of year adjustments. So remember, you have two financial statements that you prepare in a partnership or in any business. You prepare yourself an income statement and you prepare yourself a balance sheet. Just to revise, the income statement shows you how much profit you've made. So the reason for preparing an income statement is to calculate our profit, how much profit we've made in the year, in the month, or in the financial period. At the same time, we also prepare a balance sheet, and the balance sheet is something that shows us our financial position. So what that means, the financial position, it tells me how my business is doing at that specific time. It's almost as if you're taking a photograph or a snapshot of what assets and liabilities and owner's equity are in your business at that particular time. So what you need to remember is that when you're doing an income statement, your profit shows only your incomes and expenses. So those will go in the income statement. And when you do your balance sheet, you remember that you're going to show the assets, the liabilities, and then finally the owner's equity. So you can think of the balance sheet as setting out the accounting equation that you'll remember from grade 10. Your assets are equal to your owner's equity plus your liabilities. So your assets, liabilities, and owner's equity all are included in the balance sheet. So that was just a little bit of revision on how you do an income statement and a balance sheet, what goes in there. But now we're going to focus on the different types of adjustments that you can get at year end. And I've listed them here for you. You need to make sure that you know how to handle each and every one of these adjustments. I'm not going to go through all of them in detail. We're going to work through a practice question and have a look and see how to do the adjustment when it comes up. But these are the main concepts that you need to master. So the first one is being able to master a trading stock deficit or a trading stock surplus. Make sure that you know what that concept is, how to calculate it, and how to put it in your books. Second one that's very closely linked to it is being able to do your consumable stores on hand. These two together usually come from an adjustment that starts with a physical stock take. So when we work through the activity that I've got prepared for you, we will see that sometimes there's a physical stock take adjustment where you have to calculate your trading stock deficit and your consumable stores on hand. Make sure you know how to do it, because that is one that comes up again and again and again in an exam question. Then specific to grade 11 is the new one that you learned this year, which is the adjustment for depreciation. So that is really covered in your chapters in the textbook on fixed assets. So I'm not going to spend a lot of time explaining how to do it. If you want to know how to do it, you can watch our show on fixed assets, or you can consult your textbook. But this is the new one that you've learnt in grade 11. And remember, when you're doing the depreciation, that is recorded in the income statement as an expense for the year. And it is also included in note number 3, which is the note on fixed assets. So we're going to get a set of adjustments, and in today's question, we've got note 3. We're going to revise how to do it, and you'll see how to deal with depreciation. Then the next 4 all fall into the same kind of category. I'll just bracket them here so you can see. We usually have something called accrued income, income received in advance, accrued expenses, and prepaid expenses. Now, what's important? When you are preparing your income statement, what you need to realize is that that must show the income that we have earned this year, not the income that we have received. So be very, very clear on the difference between income that has been earned and income that has been received. You don't necessarily immediately earn all the income that you've received, and you also don't automatically receive all the income that you've earned. So let me explain what I mean by that. Think about selling stock to a debtor on credit. If you sell some stock to a debtor on credit, you have earned a sales income at that time. But because that person is a debtor, that means that that person is only going to pay you at some time in the future. So what that means is that you have earned the income because you've sold the stock to the debtor, but you have not yet received the money. Now, in an income statement, we have to show everything in the period that it was earned, but not necessarily in the period that it was received. And if you remember your GARP principles from grade 10, you will know that there's a special GARP principle called the matching principle. And this matching principle, if you revise your definition, this is the principle that states that we record incomes in the periods that they were earned and expenses in the periods in which they were incurred. So if you've used the telephone, it doesn't matter whether you've paid for it or not. The fact that you've used it means that you have immediately incurred a telephone expense, and that telephone expense must be shown in this year's expenses. So these are the 4 kinds that you need to adjust for. Firstly, there's accrued income, which is income that you have earned but not yet received. So an example of that would be, if I do work for somebody, I earn current income, but that person is only going to pay me in the next financial year. So I do work for a customer in February, which is the end month of my financial year. If that person's only going to pay me in March, that lies outside my financial year, but I still have to record in February that I've earned that money because I did the work in February. The exact opposite of that is what we call income received in advance. And this is income that I have received but not yet earned. So the person has paid me for something, he or she has paid me for a service, but I've not yet delivered that service. For instance, somebody might pay their rent in advance, and I've received 1 month's rent, but the person hasn't lived in my house that I'm renting to him yet. I've received the income, but I've not yet earned it, so I have to record that as income received in advance. Now the same will apply to expenses. We have accrued expenses and prepaid expenses. Accrued expenses are expenses that you have incurred. So we use the verb incur. When you do something that costs you money, we say that you incur an expense. For instance, if I'm using the telephone, I'm incurring an expense because I'm going to have to pay that phone bill at the end of the month. But an accrued expense is an expense that has happened. In other words, you've done something to cost you money, but you have not yet paid that. So that is something we have to pay in the future, but we have to add it to the expenses for this financial year because we have used that telephone in this financial year. And the last one, that is matching principal adjustment, is the prepaid expenses adjustment. And these are expenses that you have paid in advance for the next financial year. Now, this one's usually easy for grade 11 learners to understand, because I'm sure you all have cell phones, and I'm sure you all, or if you're not on a contract, buy yourself some prepaid airtime. So let's take this example. Let's say that at the beginning of the month, I buy 55 rands worth of airtime. And then at the end of the month, I check my balance, and I see that there is 20 rand left over. So I've bought 55 rand at the beginning of the month. I then use my phone my friends, and at the end of the period, I see that there is 20 rand left over. If one of your friends had to ask you, how much money did you spend on airtime this year or this month? Then you're not going to say that you spent 55 rand. Reason being that you have 20 rand left over. So you haven't used up all of your 55 rand. You've actually got 20 rand left over. So your telephone expense for the month is actually only 35 rand. This is your real expense. So out of the 55 that you have bought at the beginning of the month, 20 rand was left over, so your expense for the month is only 35 rand, and this 20 rand can be used next financial period. Next month you can phone for 20 rand, you've already bought it, you've paid it in advance, and this amount we are going to call a prepaid expense. So make sure you calculate this prepaid expense carefully. That is the amount that's left over. You have paid it in advance for the next financial year, and you will have to record that and calculate it accordingly. And the adjustment that usually comes up with this is the insurance adjustment. So we will see that insurance adjustment coming up. That's the one that they usually have. I'm sure you've seen it before, where they say that there's an annual insurance premium that has been paid for a certain length of time. And when that happens, you have to calculate which portion of that is prepaid and must therefore be subtracted. But we'll look at this with a practical example in a few minutes' time. Okay, now our next adjustment is an adjustment that it's probably the easiest adjustment to do, but you have to make sure that you can identify it. This is what we call a balance sheet adjustment, and it's the adjustment that takes place only on the balance sheet. In other words, you don't do any journal entries to show it. And this adjustment is for the current portion of the loan. So just to take an example of how to do this adjustment, they will give you somewhere in your trial balance a number for non-current liabilities. So there'll be some figure in your trial balance that shows your non-current liabilities, and let's say that that figure is, let's say that that figure is 100,000 rand. Now you should know from your definitions of accounting that non-current liabilities are liabilities that have to be paid off in a long period of time. So they're not going to be paid off next year. You've got at least 1 year's time before you have to start paying them. This 100,000 rand is not going to be paid off next year. It's going to be paid off for a long period of time. Then they tell you that out of this 100,000 rand, they might give you an adjustment that looks like this. They might say that 20,000 of the loan will be repaid next year. So what this means is that we've got 100,000 rand that we owe, but they tell us that the terms of the loan repayment say that 20,000 rand of this loan must be repaid next year. Now, mindset is it's not true to say that I have a non-current liability of 100,000 rand, because there's 20,000 rand that's going to be repaid next year, and we know that things that we repay next year are called current liabilities. So if you've learnt your financial statement format correctly, you'll know that under current liabilities you usually have trade and other payables, which is where you would find your creditors and all of the various other things that have to be paid off in the short term. And we also have an item here that is called your short-term loan. Short-term loan. So the short-term loan is that portion of the loan that has to be repaid in the next financial year. So when we see this adjustment, which is just a balance sheet adjustment, that tells us that 20,000 rands worth of the loan is going to be repaid next year, our adjustment is very easy. All we do is we subtract 20,000 from the 100,000. You can do that in your heads. 100 minus 20 is 80. And we replace the figure of 100,000 with our 80,000, because it's not true to say that the full loan of 100,000 rand will be paid off in a long period of time. In fact, only 80,000 rand will be paid off within a period of longer than a year. And we shift the 20,000 to our short-term loan over here, because the 20,000 is the portion of the loan that's going to be paid back within the next financial year. So remember, when you see this adjustment, you always subtract the current portion, in other words, the part that's going to be paid off next year. We always subtract that from the loan, and we move it from non-current liabilities. We simply move the 20,000 rand down into our short-term loan as a current liability. No other entry is required. You just move something from non-current to current. We will see one of those adjustments in the practice question that we're going to go through, so make sure you understand how to do it, and you'll see a practical example of it just now. Okay, the final two are errors and omissions. So these are just transactions that you've recorded in the wrong way. An error is when you've made the wrong entry, and then you just have to make the entry that fixes that adjustment. So for example, you've bought stationery, but you've recorded it as equipment. You then have to subtract from equipment and add it to stationery, or whatever the case may be. You have to do a certain adjustment for every different error. And an omission is simply any transaction that was not recorded. So if we didn't record a transaction at all, for example, when a bad debt needs to be written off and we haven't done that, all we're going to do is record it in the correct place in the financial statement, and you just make the entry that records the transaction like you should have done. So that can also be an example of an end-of-year adjustment. Now, I know that many learners look at this whole list of adjustments and they find it quite challenging, and they think to themselves that there is so much to do, there's so much to learn, and they feel quite overwhelmed by the question. What I challenge you to do, mindsetters, is go through your textbooks and check to see every question that you have will have these adjustments repeated, just with different accounts that are affected and different figures. So make sure you know how to do these 10 different ones, so that when you work through your textbook, you can identify, oh, this is a trading stock deficit, or here I have to work out an accrued income. When you get into the hang of that, they actually can't trick you in an exam, because you've seen all of the different types of adjustments before, and if you've practiced them enough, you will soon become good at identifying them. So let's look at just some steps that have to happen. So when you're doing an income statement or a balance sheet, what you normally need to do is you need to record the opening balances of all the accounts in the correct places in the financial statements. This is like your warm-up. If you're going to gym, you need to warm up first before you actually do the physical exercise. So the first step is to look at your trial balance. I'll just show you an example of a trial balance. It looks like this. So you get a whole long list of figures from a trial balance over here, extract from the trial balance, and you tick them off and record them all in the places where they are supposed to go. And those are your opening balances that you have, and after that you then do the adjustments. This is why it's so very important to know where everything goes. You don't want to waste time in an exam thinking, okay, now hang on, what goes in note 4? What goes in note 5? This needs to be so automatic that you can simply see the number and say immediately to yourself, it's got to go into this note, or it's got to go into this part of the income statement. So the format is very, very important. That's why I've put it here on the notes that it is essential to learn the format of the income statement. Essential. Learn the format of the income statements and the notes. If necessary, take a blank sheet of paper and write the different accounts over and over and over again, so that you understand the format, know where everything goes, because you don't want to waste time not knowing your format. Then, after you've recorded those opening balances, you've got an open bracket that shows the number to begin with, and then you make the necessary adjustments. Now what happens is, every entry in accounting, as you'll know from grade 10 and even grade 9, has got at least one debit entry and one credit entry. So there's something that's going to be on the debit side and something that's going to be on the credit side. You must be able to identify if something's added to one side, it must be added or subtracted from the other side as appropriate, and make sure that you can identify what both of those entries are. Now, in an exam, we don't have time to test the entire balance sheet or the entire income statement. All we can do is test an extract, maybe an extract from the balance sheet, one or two of the notes. So you're not going to have to do all of the notes. And my key tip here is that if you are not required to do a particular note, so let's say you know that there's an entry that has to go in trade and other receivables, but your answer sheet doesn't have trade and other receivables in it, then you leave it out. Don't try and put it somewhere else if you know it's supposed to go in trade and other receivables. There is no mark allocated for it, and you're just wasting time if you try and put it in a different place. Okay? Then another key thing to remember when you're answering these questions, please remember that the income statement must reflect all your income and all your expenses for the year, not what has been received and spent, but what has actually been earned and what has been incurred. I made that point earlier when I explained to you the difference between money that you've received and money that you've earned. Make sure that the income statement reflects the actual income and the actual expenses for the year, and that's very important because as a partnership you have to pay tax on your profit, so you need to make sure that you get that profit stated correctly. Then finally what you do, last two steps, you close all your brackets off and add up the totals in the money column, total every column, and make sure that these method marks are very important. So they can make the difference between passing an exam or failing an exam. I normally tell my learners in class, if you're approaching an exam and you see that there are 5 minutes left, that's the time when you stop trying to work out adjustments, but you just go to all your totals in your income statements and balance sheet, add up everything, and make sure that you get all of those method marks. There can sometimes be up to 8 or 9 different method marks in a set of financial statements, and you want to make sure that you get them all. And then the last important tip is that if your balance sheet does not balance at the end, then do not spend time being worried about it. Do not spend time trying to find the missing number. Just accept it and move on to the next question. You don't want to waste time in an exam by trying to get this balance sheet to balance, because there could be a whole other question that counts 20 or 30 marks later on in the paper that you're not going to get to, and you're not going to finish the paper, and the chances are that you've only lost 2 or 3 marks in the balance sheet if it doesn't balance. So those are your tips for how to answer these questions, but the key thing is just to practice this as often as you can and make sure that you have done enough examples so that you are confident and accurate when you get to an exam situation. Okay, so let's look at our first exam question. So this is a question from the 2014 Grade 11 National Syllabus Exemplar, and we're provided with information relating to KD Stores, which is a partnership owned by the two partners, Kay and Dean. And what we're required to do is to prepare a whole lot of notes to the financial statements. Here it tells us we must do the note on fixed assets and we must do the note on current accounts. And then we have to also prepare the balance sheet on the 28th of February 2013. And it says specifically that you must show your workings in brackets because the notes to the balance sheet are not required. So they only want the fixed asset note, they only want the current account note, and very importantly, you can probably see that they have not asked you in this question an income statement. So most of the adjustments have got one half of the adjustment is in the income statement, the other half of the adjustment is in the balance sheet. Sometimes you get only an income statement to do, other times you get only a balance sheet to do. Very important to realize what you're doing. And what we can see is that we're not required to make any entry in the income statement, so we're going to kind of leave that part out. So now let's have a look at the information that's been given. So they've pre-printed quite a few of our figures here in the note 3, which is the fixed asset note. And then they've given us the current account note to do, but they've left a whole lot of items blank. And what you should first be doing is you should enter all of the different subheadings that you don't have. For example, you need to be able to work out what appears on all of these lines. I would suggest that when you get a blank financial statement, write in these things as quickly as you can so that you know what has to go where. So it's about time to take a break, and we'll get to the question now. What I'd suggest that you do, see if you can, during the break, fill in these headings that have to go there, and also look at the balance sheet and see if you can fill in the headings that have to go between non-current assets, current assets, and the various equity and liabilities items that have been left out. See if you can fill them in, and when we get back after the break, we'll tackle the question. Do the work now and put in the missing numbers. So in the meantime, let's take a break, and we'll see you shortly. Welcome back, Mindsetters. Before the break, I asked you to complete your structural balance sheet, your skeleton balance sheet, with the items that go in here. So just check that you know what's going on. When we look at our assets section, under non-current assets, we normally have two items. They are your fixed assets, which are the ones that appear in note 3, and then they are your financial assets, which is fixed deposits maturing within a period of longer than a year. Then under current assets, remember the format. We've got first inventories, then trade and other receivables, then cash and cash equivalents. Very important that you understand those formats, and remember that the inventories go from note 4, trade and other receivables are note 5, and cash equivalents are note 6. Then under the equity and liabilities section, most of this has been printed for you, but remember that under current liabilities we put our trade and other payables, and there could be other things that will appear here, like a bank overdraft and a short-term loan, but if we see that in an adjustment, we'll add it as we go along. I also asked you to look back at the note on the partner's current accounts, and there was a whole lot of space left over here under the net profit as per income statement. What has to go in there are the partner's salaries, the interest on the capital, and their bonuses, all three of which added up together give you the primary distribution of profit. It's not essential to do them in this order. So you could have started with the interest on capital, then the salaries, then the bonus. Doesn't matter really what order you've put them in, but the most common one is to start with the partner's salaries at the beginning. And then we have the final distribution of profit that goes over here, which we'll deal with just now. And then most of this has been pre-printed for you as well. So you can see how important the format is, because sometimes the examiner will give you marks for filling in these missing figures. Okay, so now that we've got this opening format, and we didn't have to do anything for the fixed asset note because it was all pre-printed for us anyway. Let us now have a look at what we have to do. If we go to the information, we've got a whole long list of figures over here, and we're going to use them as we need them. And then we have got a set of adjustments. This is the typical format. You usually have an extract from the trial balance, which is your whole long list of figures, like this table over here, this table, and then we also have a whole long set of adjustments, which mean that the figures need to change. So what we have to do is go through them step by step, and we have to put them into the places where they should go. So let's look at the very first one, information point A. The first thing that they tell us here is that the business made a net profit of 1,020,000 Rand. So this is the business's net profit. Where do we find the net profit? This figure we find at the bottom of the income statement. So it's the final number that we are trying to calculate at the bottom of the income statement, and this figure is 1,020,000, and they've told us that that is our net profit after all our adjustments have been taken into account. So this is the profit that has to be divided amongst our shareholders. Well, sorry, not our shareholders, because we're dealing with a partnership. It has to be divided amongst our two partners. This business has only two partners, and this is the money that's available for distribution between the two partners. In other words, this is the profit and loss that would appear in our appropriation account if we were doing ledger accounts. But we're not doing ledger accounts, we're doing an income statement and balance sheet. So what I would do with this number is I would go back to my current account note, which is this one over here, and I would just record that the net profit as per the income statement was 1,020,000. I'm leaving this number here, and later on when it comes to completing this note, you will see what I'm going to do with it. It just tells me that this is the profit that's available for division between our two partners, Kay and Dean. But don't worry about that figure for now. We are going to come back to it. Let's now look at the second adjustment, adjustment B. So it tells us here, they're quite kind to us, they've told us that this adjustment affects debtors control. And they're telling us that an additional amount of 6,000 Rand must be written off as irrecoverable. If you see something that's been written off, what you have to know, if we're writing something off, that means that the debtor is not going to pay us anymore. This amount must be written off, so this is what we call a bad debt. You have done bad debts in grade 10 already when you learned the general journal. You should know how to write a bad debt off, but if I need to refresh your memory, what we're going to do is we're going to subtract the 6,000 from debtors control because that debtor has disappeared. So from debtors control, we're going to subtract 6,000 Rand. This person cannot be found, she must be written off. And then we're going to go to our bad debts figure, which we find in the income statement, and we are going to add 6,000 to my bad debts. So that's basically the adjustment. Half of it is increasing bad debts by 6,000 Rand. The other half is decreasing debtors control by 6,000 Rand. But now you need to know where these two amounts go. You will remember that bad debts goes in the income statement. I'm just abbreviating it as IS over here. Bad debts goes in the income statement. But because our question doesn't ask us for the income statement, we actually don't have to worry about this bad debt. We don't have to add another 6,000 in our income statement because we have not been asked to do an income statement. In fact, all we've been asked to do is the part of the balance sheet together with the notes, and we don't really have to worry about this. We can just pretend that we've entered it in the income statement and move on to the second half. The second half is this subtracting of 6,000 Rand from our debtors control. So here's where you have to know very clearly where you find debtors control, and you should know that debtors control appears in the note on trade and other receivables. So debtors control is part of trade and other receivables. That's where the format is important. But in this question, we are not actually being asked to do that note on trade and other receivables. We are being asked to do the balance sheet directly. So if you look at this, we're being asked to do this balance sheet directly, and our trade and other receivables actually appears over here. So because we're not being asked to do the note, we must show all calculations that affect trade and other receivables in brackets over here. So you need to remember what goes in trade and other receivables, and let's have a look at our trial balance to see if we can find the figures that have to go in trade and other receivables. And if you look down here, there's always debtors control, and from debtors control we subtract our provision for bad debts, and we could also put in here two other items. We could put in accrued income, and we could put in prepaid expenses. So you need to know the format very well. It's always your debtors control, your provision for bad debts, plus your accrued income, plus your prepaid expenses. But you will not have these two in the pre-adjustment trial balance. So we've been given a set of figures that have not been adjusted. But these two, your accrued income and your prepaid expenses, will never be found in the pre-adjustment trial balance because you actually have to make an adjustment first to get them. So they won't appear. You only create them when you find an accrued income and a prepaid expense. So we can't transfer any total from this trial balance here that we have. It's just an extract from records, and if you go down, you will see it's in alphabetical order, or mostly in alphabetical order. You can't find an accrued income or a prepaid expense because we haven't got any yet. However, we do have debtors control and provision for bad debts, and I'm going to put the opening balance of debtors control into my note. Here it is, 128,000 Rand. If I go to my balance sheet, I'm going to start off with the figure of 128,000 Rand, which is the balance on my debtors control amount. So debtors control has got a total of 128,000, and now we must make the adjustment for that bad debt. The adjustment was to write off a bad debt of 6,000 Rand, and here I've shown you that the adjustment is to minus 6,000 Rand from debtors control. So the way we need to show it is we have to go back to our balance sheet, and we have to subtract 6,000 Rand here. And now that adjustment is actually done because we've taken our debtors control balance and subtracted our 6,000. That's the first part of the adjustment, all done. Let's look at the second part of the same adjustment. And that second part states that the provision for bad debts or provision for bad debtors must be adjusted to 6% of debtors. Mindset is, I'm sure you've seen a provision for bad debts before. What that really is, if we are adjusting our provision for bad debts, our provision for bad debts is money that we are setting aside that we think our debtors are not going to pay us. So I'm sure you've had something before where you've lent a friend some money or you've lent a friend something and that friend disappears and doesn't give you that money back. We know that if we lend out things or if we let people borrow money, there's a chance that we're not going to get all of that money back. So we must make a provision using the rule of prudence, the Gr principle of prudence, which says that we must be wise and prudent when it comes to recording our financial transactions. We're not going to necessarily get all of that money that our debtors owe us, we're not necessarily going to get back. So what we have to do is we have to set aside some money, which is called this provision, for some of the debt that we're not going to get. And the question tells us that it has to be 6% of our debtors. So what we have to do is we have to look and see what debtors control is now. So you'll remember if we look at our balance sheet, we started off with this figure of 128,000 and we've adjusted it with the bad debt of 6,000. So right now our debtors control, if we had to calculate debtors control, it is 128,000, which was our opening balance, minus the 6,000 that we've just written off, and that's going to tell me how much is actually in my debtors control account right now. So let's do that with a calculator to make sure we don't make a mistake. Here it is. We're going to take our 128,000. We're going to subtract our 6,000 rands worth of bad debts. And that leaves us with the figure of 122,000, which is now our new balance on debtors control. But now they tell us that we must adjust our provision for bad debts to 6% of this figure. So out of that 122,000, there is 6% that we are not going to receive. Our debtors are not all going to pay. We have to subtract 6% of that figure, and that is our provision for bad debts. So we have to work it out, and the way we do that is we multiply it by 6 over 100, which is 6%, and we get an answer of 7,320 rand. So our provision for bad debts must be adjusted to 7,320 rand. And that is what we're going to show in our provision for bad debts figure. So if I go back here, 7,320 is the 6% that we have to write off, or well, not write off, but set aside money for future debtors that are going to be written off. So when we adjust the provision for bad debts, what we now do, we've calculated that it should be 7,320 rand. 7,320 rand. We then go back to our trial balance and we see that we already have a provision for bad debts of 12,500 rand. So now we don't want it to be 12,500 rand, we want it to be 7,320 rand. So what we must do is we must adjust this figure. We're not going to show 12,500, we want it to be 7,320. So the adjustment is going to be to calculate our 12,500 minus the 7,320. It is currently 12,500. We want it to be 7,320. So the difference between these two figures is by how much we have to adjust our provision for bad debts. So if we get the calculator on the screen, I'm going to take that 12,500, subtract my 7,320, and I will then see that I must adjust my provision for bad debts by 5,180 rand. We are setting aside less money for bad debts. So it's as if we're taking some money out of the money that we've set aside. Think of the 12,500 rand as money that's been set aside that we think we're never going to get back. But now we don't want 12,500 rand set aside, we only want 7,320 set aside. So it's as if we're taking out of that container of money that we're not going to get back, we're taking out 5,180 rand. And that figure is going to be called our provision for bad debts adjustment. So let me just write it here. 5,180 To do the adjustment, we would have to record something called a provision for bad debts adjustment. And this figure is actually going to appear in our income statement. But because we're not doing the income statement, we actually don't have to record it anywhere here. This would actually be an income in our income statement because we are getting some money back that we previously thought we would have to provide for bad debts. But since we don't have to do the income statement, we're not going to record that in this particular question. All we're going to record is now our new provision for bad debts, which has been changed to 7,320 Rand. So we've adjusted it from 12,500 to 7,320. This figure is actually going to appear in our balance sheet. It gets subtracted from debtors control. So really out of the 122,000 of debtors, we actually have 7,320 that we are not going to receive. So the correct adjustment here is to go back to your balance sheet and we have to subtract a further 7,320 Rand as debts that we are not going to get back. So we have made the first adjustment of our bad debt, and then it's this further 7,320 that we think we're going to write off as bad debts in the future. And that is your adjustment. Make sure you know how to do this one. It comes up often. It even comes up in grade 12 papers. Okay, let's have a look at our next adjustment over here. This is also an adjustment that comes up very often. It tells you that a temporary employee, B. Burns, was left out of the salaries journal in error. Poor guy, his salary has not been paid to him. So he's been left out of the salaries journal. We owe him his salary. What they now do is they tell you that his net salary was 6,290 Rand. That's his net salary. And his PAYE deduction was 15% of his gross salary. So what this means is that he was going to earn a gross salary and there was a PAYE deduction of 15% that had been subtracted from his gross salary to work out what he gets. Then it also tells you that this person has no other deductions or benefits. So this is his salary. He only has one deduction, which is your PAYE deduction. And his net salary is 6,290 Rand. Now, when you're doing this particular adjustment, what you have to consider is that the company is going to pay the worker his net salary, and then all of the different deductions and contributions are going to go to the relevant funds. They are amounts that have to be paid in terms of the contract of the employee. They have to be paid to the pension fund, to SARS, to the medical aid fund, or to various other places. So what we have to now work out is where these go. Usually what happens is when you do this adjustment, you record the gross salary in the income statement. So whatever the gross salary is, we're going to record in the income statement as the salary expense to the business. Okay? But we don't have to do the income statement now, so this part of the transaction we can leave out. The second part of the transaction is to record everybody who is owed money, in other words, the pension fund, the medical aid fund, the SARS, and the worker himself or herself. All of that money must be recorded in trade and other payables because we have to pay that over to these people. We still owe them that money. So what we're going to do is we're going to record the second half in trade and other payables, which I'm just abbreviating like this. So the worker has to get 6,290 Rand. We owe him that 6,290 Rand. So we can go to our balance sheet in trade and other payables, and we can record 6,290 Rand that we owe this worker. Poor guy hasn't been paid yet. We owe him his net salary of 6,290 Rand. But there's more. There's also some money that has to be paid to SARS on the employee's behalf. Okay? So we owe SARS some money as well. So to calculate what we have to pay SARS, we need to think about the following. Okay, I'll show you this calculation here. You're going to start with the employee's gross salary, and we don't know what that gross salary is because remember our question gave us only his net salary. They told us that his net salary was 6,290. But they did tell us that he had only one deduction, and that was PAYE, and that deduction was 15% of the gross salary. So we know that he has only one deduction, and the deductions were the PAYE. We also don't know what that is, but we know that it's 15% of this worker's gross salary. And then we know that there's a net salary. After you subtract this PAYE, you get the amount that the worker actually needs to get, which is the net salary of, we had it here, 6,290 Rand. 6,290 Rand. So we had some gross salary, let's call it X, and then we worked out 15% of that X to get some other figure here, subtracted it, and we ended up with 6,290, which is this worker's net salary. So what we now have to do is your typical want over have calculation. You take the figure that you want and you divide it by the percentage that you have, and you multiply that by the rand amount that you have. I'm sure you've seen this before when last year you did gross and net salaries. So we need to realize that the gross salary is 100%, and from that we subtract 15% in PAYE, and we are left with 100 minus 15, which is 85%. So what you should be able to see is that this net salary of 6,290 is 85% of the gross salary of 100. So now we can use this little set of ratios to calculate the figure that we want. So we actually want this PAYE figure, we actually want this 15%. So what we're going to need to do to calculate this 15%, we're going to take the 6,290 that we have, we're going to multiply by the percentage that we want, which is 15%, and we're going to divide by the percentage that we have, which is 85%, because this 6,290 Rand represents 85% of our workers' gross salary. And this should give us the PAYE amount. So let's get the calculator and just enter it in. What I need to do is I need to take my 6,290 Rand, I need to multiply it by 15 and divide it by 85, as per that calculation that I've written for you over there. And the answer comes to 1,110 Rand. So we know that this worker has to pay 1,110 Rand to SARS, but we as the business are going to do it on his behalf. So we've got another payable to SARS of 1,110 Rand, and that 1,110 Rand is going to be recorded here as trade and other payables. So that is the figure that has to go to SARS based on the worker's full salary. So that's the end of that adjustment. Let's have a look again at the next one. Our next adjustment is this one that they love to ask, which comes up again and again and again. We say that there's an insurance policy with an annual premium of 46,680 Rand, which expires on the 31st of May 2013. Now, usually when you have an insurance policy like this, they're asking you to calculate what part of the insurance policy is prepaid for next year. So it's got an annual premium. So what that means is that we're paying the amount of 46,680, and we're paying it for the full calendar year ending on the 31st of May 2013. In other words, we paid it on the 1st of June and it ends on the 31st of May. What I would advise you to do when you see an adjustment like this is to draw a timeline. Let's draw a timeline for this adjustment. So what we need to do when we're doing a timeline, we put our financial year over here, we get the starting and ending dates, and we know that this business is asking us to do the balance sheet for the 28th of February 2013. So you normally do a balance sheet at the end of the financial year, so we know that our financial year ends on the 28th of February 2013, which means it must have started on the 1st of March 2012. So this is our timeline for the beginning and the end of the financial year. So let's just write those figures in there, beginning and end. Now, the adjustment tells us that there's an insurance premium that we've paid. We've paid an insurance policy with an annual premium which expires on the 31st of May 2013. But if you look at this timeline, our financial year ends on the 28th of February, so the insurance premium ends somewhere here on the 31st of May 2013. That means that we have prepaid for this period of time, and we started paying from the 1st of June, somewhere over here, 1st of June 2012. So this green timeline that I've drawn shows me when I first paid the insurance premium, and it extends beyond this financial year, and from this period to the 31st of May, this part is my prepaid expense. So I've actually prepaid insurance for this number of months. In other words, I've prepaid insurance for March, for April, and for May. I've prepaid actually for 3 months. This little period that I've highlighted here is a 3-month period of prepaid insurance. So this is the amount that has to be shown as a prepaid expense in my note on trade and other receivables, and this is also the amount that has to be subtracted from my insurance figure in the income statement, because I haven't spent all of this money on insurance. I've only spent these 9 months on insurance for this year, because the remaining 3 months are our prepaid expense. So the way we have to calculate it is we have to look and see what our prepaid expense was. It was 46,680. We've paid an amount of 46,680 for this entire period that I've marked here in green. But we want to subtract the 3 months that fall outside of our orange financial year. So what we need to do is we need to take our 46,680 Rand, and we have to multiply it by the number of months, 3 months over 12. We're going to work out 3 months insurance and subtract that and record that as our prepaid expenses. So let's get the calculator up. Our prepaid expense is going to be 46,680 times by 3, divide by 12, and my answer comes to 11,670 Rand. So what that means is that out of this insurance premium of 46,680, 11,670 has been prepaid, and this is the figure that we need to go and record in our trade and other receivables as prepaid expenses. So let's go and do that. 11,670 needs to be recorded over here, plus 11,670. So we record that there because it is a prepaid expense. So that's the end of that adjustment. Quite a bit of hard work to calculate it, but I'm sure if you've seen that adjustment once, you get the same adjustment again and again and again and again, only with different figures and different numbers of months. Okay, let's look at our next one. Our next adjustment here is an adjustment where it says K, who's one of our partners, remember, took goods at cost price for personal use. The marked selling price was 57,600, and the markup was 80% on cost. So what we need to do is we just need to record that as the goods that Kay has taken for her personal use. It tells us what the marked selling price was, and it tells us what the markup was. And what they're testing here is that you must remember that because Kay is a partner, she takes goods at cost price. Remember, all drawings of trading stock are done at cost price. They are not done at selling price. So the marked selling price was 57,600 and the markup was 80% on cost. The first step we need to do in this adjustment is to calculate the cost price. Now that is a skill that you would have learned in grade 10, how to calculate a cost price if you've got a selling price. The formula is you take the selling price times 100, divide by the markup plus 100. So in this example, we've got the selling price of 57,600. So let's write that over there. And we're going to multiply this by 100, and we're going to divide it by 100 plus the markup. The markup here is given to us at 80%, so it's going to be divided by 180. So if we want to calculate the cost price here, we take the selling price of 57,600, we're going to multiply it by 100, and we're going to divide it by 180. So let's do that to calculate the cost price. So it's going to be 57,600 times by 100 divide by 180, and the answer comes to 32,000 Rand. So in other words, these goods had a cost price of 32,000 Rand. Let's just record that here. The cost price equals 32,000 Rand. Now, if the owner or the partner in the business takes stock at cost price, what we need to realize is that this affects her drawings, and it also affects the trading stock that is in the business. So you should know where you find trading stock. Trading stock is found in note 4, which is the note on inventory, and note 4 appears in the balance sheet. So what we're going to have to do is we're going to have to go to the balance sheet, and we're going to have to find our trading stock figure and subtract 32,000 Rand from it, because the owner has now taken these goods out of the business. She's taken them for her own personal use. And at the same time, we have to go to the drawings of the partner, so it's drawings of partner K, and we have to add 32,000 Rand to her drawings because she's now drawn stock from the business. So let's see where we have to do that in the financial statements. Remember, trading stock appears in note 4 to the balance sheet. So if I go back to my balance sheet over here, we're going to make some entry here in inventories, but we have to start off with our opening balance in inventory, which was our trading stock figure here of 695. Here it is, trading stock, 695,130. So I'll open the balance of 695,130 in here. And then I have to subtract the 32,000 that I've just calculated, because we don't have all that stock anymore. One of the partners has taken the stock for her personal use. So that's the first half of the adjustment. The second half of the adjustment deals with the drawings of the partner. And again, here it's important to know where you find it in the financial statements. The drawings for the partners appear over here in the note on the partnership's current accounts. So here's where you find the drawings. We haven't got to doing this yet, but let's just make a note that K's drawings, whatever the figure is, we need to add 32,000 Rand in here. Remember, you are allowed to answer the questions in pencil, so I'm going to put this here in pencil, and we're going to erase it just now when we are finishing this current account note. Just remember that the drawings for the year have to be 32,000 Rand. So our next adjustment is the adjustment on the loan. And it tells us that the interest on the loan from Goodwill Bank, and it's not been entered yet. What they've done is they've given us here an extract from the loan statement. This is the extract from the loan statement, and what it shows us is our balance at the beginning of the year, our balance at the end of the year, and various changes that have happened during the year. So they've told us that the interest on the loan has not been entered yet, and the loan statement reflects the balance of 625,000 at the beginning. Then there was interest that needed to be capitalized, and then there were monthly payments of 195,000. So what we've really done is we started with 625. We made monthly payments. If you're repaying a loan, you are spending money, and this figure needs to be in brackets because you are paying off the balance that you started with. So we started with 625, we've paid off 195, and we have to calculate what the interest was. This is interest that has been capitalized, which means if the interest is capitalized, it is added to the loan. So what we would do here, we need to calculate this missing question mark over here. If we put an X in here, I can show you that we started with 625. We have to add X because X is the amount that's capitalized. We have to subtract the 195,000, and that's going to give us our total of 508,125. So what we need to do is we can write an equation. We can say that the 625,000 Rand that we started with, plus the interest, which is X, minus the 195,000 that we've paid off, equals our amount of 508,125. So now it becomes very easy because all we have to do is we have to solve for this X over here. So what we're going to do to get X on its own, I must get rid of the 195,000 by adding 195,000 to both sides. So if I add 195,000 to both sides, this one falls away, and I'm left with 625,000 plus X. Then to get X on its own, I must subtract 625,000 from both sides. So now I've got X all on its own here, and we've got the calculation for X, it's 508,125 plus 195,000 minus 625,000. That will give us the amount of interest that we had. So what I will do is I'll go to my calculator here and take 508,125 plus 195,000 minus 625,000, and the answer that I get is 78125. So I know that my interest on the loan was this figure of 78125. Let's just write it down. And that is really the interest on the loan that I've had to calculate. That amount I need to show in my in my balance sheet as the loan amount, and I also have to show the 78125 as my interest expense in my income statement. But of course I'm not doing the income statement here. All I'm doing is the balance sheet, so I really only need to consider the amount on the loan at the end, which is the 508,125. That amount needs to be shown, because it's the balance on the 28th of February, that amount needs to be shown as my non-current liability in my balance sheet. So that figure needs to be, I'll write it here, 508,125. So I don't have to record the interest here, because the interest needs to be shown as an interest expense in the income statement. But I showed you the calculation in case you needed to do an income statement, you would need to consider that figure. Now, if we have to look at our next adjustment, it tells us some more information about the loan. It says, according to the loan agreement, the loan will be reduced by 120,000 over the next financial year. This is that balance sheet adjustment that I explained to you a little bit earlier when I said that we are going to do it on the balance sheet and get rid of the amount that's a non-current liability and move it to current liabilities. So out of the 508,125 that I owe, there's 120,000 that is a current liability. So all I have to do, it's a really, really easy adjustment. I have to go to my balance sheet, and from my 508,125 that I have here, I'm just going to get rid of the 120,000 that I'm going to pay off next year and record it as my short-term loan under current liabilities. So it's a short-term loan of 120,000 Rand. So the 120,000 Rand has effectively moved from being a non-current liability, it's moved to current liabilities, because that's the part of this loan that's going to be paid off within the next financial year. If we look at the next adjustment, we will see that the next adjustment deals with a fixed deposit. And what they're telling us, it's the same type of adjustment except dealing with assets. It's the same type of adjustments as the loan adjustment, but except now it deals with fixed deposits instead of with loans. They tell us that there are two fixed deposits at Queen's Bank. There's one fixed deposit of 60,000 Rand, which is going to mature on the 30th of September 2013. So our financial year ends on the 28th of February, so that amount is going to be received in cash. It's going to mature and come back to us in cash before the 30th of September 2013. So what we have to do with this fixed deposit, we have to do the same thing. We have to move it from non-current assets to current assets. It actually is going to be included in our cash and cash equivalents, because we're going to get that amount of 60,000 Rand back. So to do this adjustment, we have to go back to our trial balance, and you'll see that here is a fixed deposit with Queen's Bank of 850,000. Here's the figure that we're looking for, fixed deposit with Queen's Bank. But they're telling us that it's not that total of 850,000. We're not going to get all of it over a period of longer than a year. 60,000 of that is going to be received next year. So what we have to do is we have to go to the balance sheet, which looks like this, and under financial assets, we're going to record our 850,000 Rand for our two fixed deposits, but 60,000 of it is going to be received in our current asset section, and that goes in cash and cash equivalents. That 60,000 Rand is going to become cash in the near future, so we're going to record it over here in cash and cash equivalents. So again, it's just a balance sheet adjustment. That's all we have to do. Bear in mind that cash and cash equivalents also has some other figures. So if we look back at our trial balance, you will see that we also have here a cash float. Remember, anything dealing with cash, in other words, your bank balance, cash float, savings account, petty cash, or fixed deposits maturing within less than a year, they are all going to be shown in our cash and cash equivalents note. So this 2,000 Rand, what we just have to do is include it together with the 60,000, it's the cash and cash equivalent. And normally we would include bank here as well, but if you look carefully at the question, you will see that this bank is actually a bank overdraft. So you need to remember that bank overdraft of 9,800 Rand is a separate item in current liabilities. You actually owe the bank this money. It's not that the bank owes you the money, you owe the bank that money. So what we have to do is we have to take this 9,800 and instead of recording it in cash and cash equivalents as we normally would, we would go further down and write an entry here for bank overdraft. Under your current liabilities, our bank overdraft is 9,800 Rand. So just make sure that you understand the difference between a bank overdraft and a positive bank balance. If you're in doubt, go back and read about bank reconciliation to understand what an overdraft is and why it is a negative bank balance. Now we have another long adjustment, which is the adjustment on fixed assets. Now, you will have done fixed assets very often because they are a separate section in your textbook, and there's the whole note that you have to know how to do. We're not going to do this fixed assets adjustment for you or with you now because that's beyond the scope of today's lesson. The fixed assets are usually done in the fixed assets section, and we've got some other shows that you can watch about it. We're going to skip this one, but post the answers for you. But just make sure that if you read it, you know how to do the adjustment on fixed assets and know how to do note 3. But the focus of this is really the partnership financial statements, and we're going to look at this final piece of information, which is the important stuff about the partnership agreement. So it tells us here that the partnership agreement allows for the following. Firstly, there are salaries to each partner of 20,000 Rand per month. You need to know where to record those salaries for each partner, and you should remember that they are recorded in our special current account note because the current account note deals with transactions by partners or transactions to partners. So these partners need to each get 20,000 Rand per month, so we need to work out what they're going to get per year. So the salaries of each partner is going to be 20,000 Rand times 12 because we need to record our yearly salary in our note. So what's going to happen is I'm going to do the calculation here. To work out what each partner is getting, we will take 20,000 Rand per month times by 12 months. Each partner is going to get a salary of 240,000 Rand. I'm sure you know where to put it because I'm sure you've done it before. But let me refresh your memory. The 240,000 Rand has got a very special place. It appears underneath in the primary distribution of profits. We've got the salary of partners. And each partner got a salary of 240,000 Rand. So let us just record those figures in here, 240,000. The little trick that they put in here is telling you their monthly salary, but remember that in here we record the yearly salary as 240,000 Rand for each partner. Okay, let's look at what else they tell us about the partners. They also tell us that interest on capital is at 10% per annum. And they tell us that partner Dean increased his capital by 200,000 Rand on the 1st of December 2012. So the partnership is going to pay each partner 10% interest on the capital contribution, but partner Dean increased his capital by 200,000 Rand on the 1st of December 2012. So what we need to do is calculate the interest on these two partners' capital balances, and we get their capital balances from our from our trial balance. We get the figures. K has got 1.8 million and Dean has got 1.2 million. So we have to calculate 10%, but we have to bear in mind that partner Dean increased it by 200,000 Rand. So we need to do two separate calculations. Let's take partner K first because hers is easier because there were no increases or decreases. It's only partner Dean who increased his capital. So all we have to do to work out the interest on capital for partner K, all we need to do is we need to work out 10% of this 1.8 million rand, and that is an easy calculation. Let's do it on the calculator. She is going to earn interest of 10%, 10 over 100, times by her 1.8 million capital contribution, and the answer comes to 180,000 rand. So we can immediately go and record that 180,000 rand in the correct place, which is over here, interest on capital. Partner K got an interest on capital of 180,000 rand. To calculate the other partner's interest on capital, we need to bear in mind that there was a change in his capital contribution. So what we should do is draw a timeline again. So to calculate partner Dean, our financial year starts on the 1st of March and ends on the 28th of February 2013, and this is 2012. And we know that during the year, he changed his capital contribution. So let's look back at what it says. It tells us that partner Dean increased his capital by 200,000 on the 1st of December, and this has been properly recorded. So if we go back to the timeline that I've drawn, we will know that he has increased on the 1st of December 2013. He increased his capital contribution by 200,000, and we know that that was properly recorded, so that that figure is already in the capital contribution that we have for him. So if we look here at our trial balance, we will see that that 200,000 is included in this 1.2 million that we have for partner Dean. So let's go back and fill in the missing figures. We see here that at the end of the year, partner Dean had 1.2 million rand, and he had increased it by 200,000, which means at the beginning of the year, he had 1.2 million minus the 200,000 extra that he put in, so he had 1 million at the beginning of the year. So if we now want to work out what the interest is, we have two separate calculations. We have to work out the interest for this period of time, which is on 1 million rand, and then we have to work out the interest on this period of time, which is on 1.2 million rand. So we have two separate interest calculations. Fortunately, the interest calculations are pretty easy. We know that the interest rate is 10%. So to work out the first period of time, we're going to take 10% of 1 million rand, which is what he started with, before he put in the extra 200,000. And he earned that money for this period of time from March, the beginning of the financial year, up to the 1st of December when he put in that extra 200,000. So that's going to be for March, April, May, June, July, August, September, October, November. That is going to be for 9 months. So that's the first calculation that we need to do. The second calculation that we need to do is the calculation on this part of the year. In other words, from the 1st of December all the way to the 28th of February. So the second part of the calculation is going to be to take 10%, but now it's not 1 million, it's 1.2 million, because he's increased the capital contribution by an extra 200,000 on the 1st of December. That will be for the remaining 3 months of the year, in other words, for December, January, and February. So these two amounts are the total interest that our partner is going to earn in this calculation. So let's work it out quickly. We're going to work them out separately and add them together. So our top interest calculation will be 1 million. Make sure you count the zeros correctly. Times by 10%. Times by 9 over 12. And the answer comes to 75,000 rand, which I'll write here. Second half of the calculation is 10 over 100 times by 1.2 million rand, and that one I'm going to multiply by 3 over 12, and the answer comes to 30,000 rand. So the total that this partner Dean earned is going to be the 75,000 plus the 30,000. Let's enter it into the calculator to make doubly sure. We get an answer of 105,000 rand, which is the interest that this partner has earned for the year. So this 105,000 we're just going to record in exactly the same place as the other partner. We'll just record it here as 105,000. Okay, there's one more item that appears here in the primary distribution, which is the bonus of the partner. And if we look back at our partnership information, it tells us that only one partner earned a bonus. It says that Dean received a bonus of $175,000 for the year. Nothing else we need to do. We just need to take this $175,000 and put it in the bonus column. So let's do that. So in the bonus column for partner Dean, make sure you put it in the right column. We put the $175,000 in. And the other partner did not earn a bonus in this financial year. What we now need to do is work out the primary distribution of profit, which appears here. The way we do that is very easy. We just add the figures for salaries, interest, and bonuses. We add the three figures together for each partner and write the total in. So if I'm doing it for Kay, I'm going to take the $240,000, which was her salary, and I'm going to add the $180,000, which was her interest, and I'm going to get a total here of $420,000. So her primary distribution was $420,000. The other partner earned $240,000 in salary, partner Dean. He also earned $105,000 in interest, and he earned $175,000 as a bonus, and the total that we have is $520,000, which is his primary distribution. So now we've calculated the primary distributions. You'll remember that at the very beginning of this lesson, we recorded the net profit as per the income statement as 1020000 at the top here. I'd erased it in the meantime, but here it is again. The 102,000, just to remind you where we got it from, was our very first adjustment. The business made a net profit of 102,000. I'm just recording it because I'm going to use it now to calculate the secondary distribution and to finalize everything. So the final piece of information that they give us here is that the remaining profits or losses, in other words, after the primary distribution has been paid, the remaining profits or losses are shared in the ratio 3:1 between partners Kay and Dean, and because Kay's name appears first, she gets 3 parts and Dean is going to get 1 part. So we have to divide the profits in the ratio 3:1, and when you work out what you have to divide by, if you're sharing a 3:1, you have to divide by 4. You always add the left-hand side and the right-hand side of the ratio together. 3 plus 1 equals 4. We're going to divide the profit in 4 pieces and give Kay 3 pieces of it and Dean 1 piece of it. So now let's do that and finish this question off by recording the remaining profits or losses. So if I go back to this partnership account, I've got a net profit of 102,000, and I now have to record the secondary distribution of profits here. So to record the secondary distribution of profits, this is the key step that you must know how to do. What you do is you take the primary distribution of the 2 partners and add them together. So we're going to add the total of 420,000 plus 520,000. Let's do that first. So I'm going to take the 520,000 for partner Dean, and I'm going to add the 420,000 for partner Kay, and the total that I have is 940,000 Rand. So the 940,000 Rand is what they are getting in their primary distribution. What we now do is we take our net profit that we calculated here and we subtract this 940,000 and we see how much is left over, and that is what's going to be divided in the partnership sharing ratio of 3 parts to Kay and 1 part to Dean. So let's do that now. We're going to take the 1020 minus the 940 primary distribution. So I'm going to enter 1020. Remember, that was my total profit for the year. And out of that, I first had to pay the primary distributions of 940. So we paid the salaries and the interest and the bonus. That meant we were left with 80,000 Rand. And this 80,000 Rand is what's left over and must now be divided in the ratio 3:1. So what we're going to do is we're going to divide it into 4 parts. So divide by 4. That means that there's 20,000 Rand. Of that 80,000, we divide it into 4 parts and there's 20,000 Rand in each part. Dean is going to get one of those parts. So he's going to get one lot of 20,000 Rand. So his secondary distribution is going to be 20,000. K is going to get 3 sets of that 20,000. So we're going to take the 20,000 and multiply it by 3. That gives us a total of 60,000. So her secondary distribution is 60,000 Rand. So mindset is, don't forget, when you're calculating the secondary distribution, you're not just taking the net profit per the income statement of 1020 and splitting it in the ratio 3:1. You must first subtract the primary distribution of profit to get an answer, and then that answer is going to be split in the ratio 3:1. And then the strange thing about this financial statement is that you now have to work backwards to get the two figures at the top. So the net profit is per the income statement. You now have to add the primary and secondary distribution for each partner. So K earned 420 in primary distribution and 60,000 in secondary distribution. If you add those two together, you get an amount of 480,000 Rand. So 420 plus 60, you should be obvious that it's 480,000 Rand. In the same way, the other partner earned 520 in primary distribution, 20,000 in secondary distribution, so he got 540,000 Rand of the net profit. And the way that we can check this to see whether we've done it correctly, we should add these two green figures together. Let's do that and see what we get. So I'm going to add the 480,000, which are partner K's earnings, and I'm going to add that to the other partner's earnings, which are 540,000. And guess what? That gives me the net profit to begin with, the circled red number here. This is the net profit that we started with, and we've worked out what share each partner is going to get of the remaining profits. What you now need to do to finish this question off is you need to put in the drawings of the two partners and get the total balances on their current accounts at the beginning and the end of the year. See if you can do that. I'm sure that you can, because you would have done this before. But the key thing is to remember how to complete the top part. If you can complete the top part, the rest is easy, because you only copy the numbers from the trial balance in and work out what your balances are at the end. I hope you've learned something today. Join us again for another Accounting Grade 11 Learn Extra, where we'll be doing another question on partnerships and their financial statements. We'll see you next time. Good luck and goodbye. Hello Grade 11s, and welcome to another Learn Extra accounting show on partnerships. So you may have watched some of our previous shows in which we did the partnership ledger account. The focus on today's show is on the income statement and on the balance sheet. This is an extremely important section of work that you've got to master, because at the end of the year exam you will usually get a question of between 80 to 100 marks on this. These are the adjustments that you've learned in grade 10, and what we're doing is we're extending them to grade 11, where we're going to look at the effect on a partnership instead of on a sole proprietor. So the key focus of this lesson is, first of all, knowing how to prepare an income statement for a partnership. So you will have done an income statement in grade 10 before, and now we're going to adjust the income statement very, very slightly, dealing with a partnership instead of a sole proprietor. And then what's even more important is preparing a balance sheet for a partnership. And the reason I say it's more important is because this is the section of work where you've got your two new notes. It's notes that you didn't have in grade 10, but they are notes that you will have in grade 12, and you learn them in grade 11 when we start looking at a partnership. So those two notes are the fixed asset note, which you may remember if you've watched our shows on asset disposal or if you've done asset disposal in class, and also the very important current account note, which is normally numbered note 8. So these are the two notes that are new, and these are the ones that I would strongly suggest that you revise and make sure you learn their format. So the format of the financial statements is extremely important. When you go into an exam, you need to know exactly what goes in each note, and then you won't have any trouble doing these adjustments, because the adjustments the tricky thing about the adjustments is not knowing where the figures that you calculate need to go. So learn the format very, very well, start early, and you won't have any trouble. And what we also have here, when we're doing an income statement and a balance sheet for a partnership, the tricky thing is to do the end of year adjustments. So remember, you have two financial statements that you prepare in a partnership or in any business. You prepare yourself an income statement and you prepare yourself a balance sheet. Just to revise, the income statement shows you how much profit you've made. That person is only going to pay me in the next financial year. So I do work for a customer in February, which is the end month of my financial year. If that person's only going to pay me in March, that lies outside my financial year, but I still have to record in February that I've earned that money because I did the work in February. The exact opposite of that is what we call income received in advance, and this is income that I have received but not yet earned. So the person has paid me for something, he or she has paid me for a service, but I've not yet delivered that service. For instance, somebody might pay their rent in advance, and I've received 1 month's rent, but the person hasn't lived in my house that I'm renting to him yet. I've received the income, but I've not yet earned it, so I have to record that as income received in advance. Now, the same will apply to expenses. We have accrued expenses and prepaid expenses. Accrued expenses are expenses that you have incurred. So we use the verb incur. When you do something that costs you money, we say that you incur an expense. For instance, if I'm using the telephone, I'm incurring an expense because I'm going to have to pay that phone bill at the end of the month. But an accrued expense is an expense that has happened. In other words, you've done something to cost you money, but you have not yet paid that. So that is something we have to pay in the future, but we have to add it to the expenses for this financial year because we have used that telephone in this financial year. And the last one, that is matching principal adjustment, is the prepaid expenses adjustment. And these are expenses that you have paid in advance for the next financial year. Now, this one's usually easy for grade 11 learners to understand because I'm sure you all have cell phones, and I'm sure you all, or if you're not on a contract, buy yourself some prepaid airtime. So let's take this example. Let's say that at the beginning of the month, I buy 55 rands worth of airtime. And then at the end of the month, I check my balance, and I see that there is 20 rand left over. So I've bought 55 rand at the beginning of the month. I then use my phone my friends, and at the end of the period, I see that there is 20 rand left over. If one of your friends had to ask you, how much money did you spend on airtime this year or this month? Then you're not going to say that you spent 55 rand. Reason being that you have 20 rand left over. So you haven't used up all of your 55 rand. You've actually got 20 rand left over. So you're explaining how to do it. If you want to know how to do it, you can watch our show on fixed assets or you can consult your textbook. But this is the new one that you've learnt in grade 11. And remember, when you're doing the depreciation, that is recorded in the income statement as an expense for the year. And it is also included in note number 3, which is the note on fixed assets. So we're going to get a set of adjustments, and in today's question, we've got note 3. We're going to revise how to do it, and you'll see how to deal with depreciation. Then the next 4 all fall into the same kind of category. I'll just bracket them here so you can see. We usually have something called accrued income, income received in advance, accrued expenses, and prepaid expenses. Now, what's important? When you are preparing your income statement, what you need to realize is that that must show the income that we have earned this year, not the income that we have received. So be very, very clear on the difference between income that has been earned and income that has been received. You don't necessarily immediately earn all the income that you've received, and you also don't automatically receive all the income that you've earned. So let me explain what I mean by that. Think about selling stock to a debtor on credit. If you sell some stock to a debtor on credit, you have earned a sales income at that time. But because that person is a debtor, that means that that person is only going to pay you at some time in the future. So what that means is that you have earned the income because you've sold the stock to the debtor, but you have not yet received the money. Now, in an income statement, we have to show everything in the period that it was earned, but not necessarily in the period that it was received. And if you remember your GARP principles from grade 10, you will know that there's a special GARP principle called the matching principle. And this matching principle, if you revise your definition, this is the principle that states that we record incomes in the periods that they were earned and expenses in the periods in which they were incurred. So if you've used the telephone, it doesn't matter whether you've paid for it or not. The fact that you've used it means that you have immediately incurred a telephone expense, and that telephone expense must be shown in this year's expenses. So these are the four kinds that you need to adjust for. Firstly, there's accrued income, which is income that you have earned but not yet received. So an example of that would be, if I do work for somebody, I earn current income, but the phone expense for the month is actually only 35 Rand. This is your real expense. So out of the 55 that you have bought at the beginning of the month, 20 Rand was left over, so your expense for the month is only 35 Rand, and this 20 Rand can be used next financial period. Next month you can phone for 20 Rand, you've already bought it, you've paid it in advance, and this amount we are going to call a prepaid expense. So make sure you calculate this prepaid expense carefully. That is the amount that's left over. You have paid it in advance for the next financial year, and you will have to record that and calculate it accordingly. And the adjustment that usually comes up with this is the insurance adjustment. So we will see that insurance adjustment coming up. That's the one that they usually have. I'm sure you've seen it before, where they say that there's an annual insurance premium that has been paid for a certain length of time. And when that happens, you have to calculate which portion of that is prepaid and must therefore be subtracted. But we'll look at this with a practical example in a few minutes' time. Okay, now our next adjustment is an adjustment that it's probably the easiest adjustment to do, but you have to make sure that you can identify it. This is what we call a balance sheet adjustment, and it's the adjustment that takes place only on the balance sheet. In other words, you don't do any journal entries to show it. And this adjustment is for the current portion of the loan. So just to take an example of how to do this adjustment, they will give you somewhere in your trial balance a number for non-current liabilities. So there'll be some figure in your trial balance that shows your non-current liabilities, and let's say that that figure is, let's say that that figure is 100,000 Rand. Now you should know from your definitions of accounting that non-current liabilities are liabilities that have to be paid off in a long period of time. So they're not going to be paid off next year. You've got at least 1 year's time before you have to start paying them. This 100,000 Rand is not going to be paid off next year. It's going to be paid off for a long period of time. Then they tell you that out of this 100,000 Rand, they might give you an adjustment that looks like this. They might say that 20,000 of the loan will be repaid next year. So what this means is that the reason for preparing an income statement is to calculate our profit, how much profit we've made in the year, in the month, or in the financial period. At the same time, we also prepare a balance sheet, and the balance sheet is something that shows us our financial position. So what that means, the financial position, it tells me how my business is doing at that specific time. It's almost as if you're taking a photograph or a snapshot of what assets and liabilities and owner's equity are in your business at that particular time. So what you need to remember is that when you're doing an income statement, your profit shows only your incomes and expenses. So those will go in the income statement. And when you do your balance sheet, you remember that you're going to show the assets, the liabilities, and then finally the owner's equity. So you can think of the balance sheet as setting out the accounting equation that you'll remember from grade 10. Your assets are equal to your owner's equity plus your liabilities. So your assets, liabilities, and owner's equity all are included in the balance sheet. So that was just a little bit of revision on how you do an income statement and a balance sheet, what goes in there. But now we're going to focus on the different types of adjustments that you can get at year end. And I've listed them here for you. You need to make sure that you know how to handle each and every one of these adjustments. I'm not going to go through all of them in detail. We're going to work through a practice question and have a look and see how to do the adjustment when it comes up. But these are the main concepts that you need to master. So the first one is being able to master a trading stock deficit or a trading stock surplus. Make sure that you know what that concept is, how to calculate it, and how to put it in your books. Second one that's very closely linked to it is being able to do your consumable stores on hand. These two together usually come from an adjustment that starts with a physical stock take. So when we work through the activity that I've got prepared for you, we will see that sometimes there's a physical stock take adjustment where you have to calculate your trading stock deficit and your consumable stores on hand. Make sure you know how to do it, because that is one that comes up again and again and again in an exam question. Then specific to grade 11 is the new one that you learned this year, which is the adjustment for depreciation. So that is really covered in your chapters in the textbook on fixed assets. So I'm not going to spend a lot of time